Hi, this is Vinney Chopra. Thank you for again joining on my podcast, Apartment Syndication Made Easy. As you know, I wrote that book, which is a top seller in Amazon. Internationally also got a lot of acclaim, reviews and all. And this podcast is about syndication, about commercial investing. I like to bring great guests for you and dig into their story, their successes, and find out some nuggets from them so that you could really enjoy them and learn from them and then implement them. All right, guys. Hey, Vinney Chopra back again. Now my editors, my team is putting out even 2 or 3 podcasts a week. So I hope you're not tired of it. We want to give you so much great information so that you can make better decisions. Again, this is Vinney Chopra. I wrote the book about 3 years back, which became Amazon's top seller. A lot of people are loving it. If you want a digital copy of the book, by the way, just go to vinneychopra.com/free book. So I want 1 million people to read it for free, So it's vinneychopra.com/free book. And this is the sequel, that podcast I do, as you know, and bring a lot of great guests. I do also Vinney and Bo show, which is on every Friday live in 7 channels. And then we make a podcast out of that one. Then my senior living investing show. Many of you probably know I'm writing my 3rd book. My 2nd book is about double the size now. And that's The Positivity Brings Profitability in hardback, softback, voiceovers. I just got the edited files yesterday. My team is uploading them. And then my 3rd book is coming out on senior living investing. My goal of $2 billion yet into this senior living this next 8 years. I know we're going to do it, So thank you again for your content. I've got great friend, Erik Oliver is in the house today. And Erik is a specialist in cost segregation. So we're going to dig into all the aspects of cost segregation, guys. I mean, that's money. If you're not doing cost segregation, you're leaving so much money on the table. The profits, the NOI that you could really, make it higher NOI by doing that expense, and depreciation, which we call it. We're going to talk about all that paper loss, I call it, and right, the bonus depreciation and everything. Let me introduce Erik. How are you, brother?
I'm good. I'm glad to be here. I can't believe I'm on the same screen as Vinney Chopra. I can't believe
it. It's such a pleasure to have you.
Pleasure to be here.
Erik Oliver holds a Bachelor of Applied Science in accounting from Westminster College. Prior to joining Cost Segregation Authority, Erik was an operations manager for a multi-million-dollar landscaping and design firm in Long Island, New York. Since heading west and joining Cost Segregation Authority, Erik has been speaking at local, regional, and national events. He brings with him a passion for identifying cost segregation and educating commercial real estate owners on the benefits of cost segregation. I'm so proud to have you on, really.
Glad to be here.
Thank you. Give us some, how did you really start? And maybe you want to take back to your early career and then you made a transition. I know my audience would love to kind of get to know you. Yeah.
Sure. Absolutely. So my degree's in accounting. Quick story on that. I'm not good at English. I hate writing papers. And so I was in college and I'm like, how am I going to get out of this college? And math always came easy to me. So it was either finance or accounting. So I chose accounting, ended up getting an accounting degree, and then kind of never really used it. I went into sales, worked for a couple of companies in business development. And then those jobs took me to the East Coast, and then started having kids out there and decided I wanted to come back to Salt Lake City, where I was born and raised.
Oh, right.
And so started looking for jobs, and I came across a business development job at a company called Cost Segregation Authority. At the time, I didn't even know what cost segregation was. So I had to start doing my research and found out that it's this really misunderstood, underutilized tax benefit that people are leaving on the table. And so my career here about 6 years ago, and have been loving it. Have been loved working with clients, real estate clients, got into investing myself, And it's just been a great job, a great opportunity all around. So
I love it. I love it. So for simple term, what is cost segregation?
Sure. Cost segregation is just accelerated depreciation. So one of the benefits of getting into real estate is being able to have these paper losses to write off income. So depreciation is just like any other expense, but it's a non-cash expense that you're entitled to when you own real estate. And so cost segregation is real estate typically gets depreciated over 27 and a half or 39 years, depending on the type
residential,
of asset.
27 and a half, and commercial, shopping centers, hotels, right?
Yep, 39. Yeah. So just to make the math easy, let's say you buy a $390,000 retail space, you're going to get a $10,000 write-off every year for the next 39 years.
Yeah.
Well, cost segregation says, well, why am I spreading that deduction out over 39 years? I'm not even going to own the building in 39 years. Let me take my deductions now. And how can I accelerate those? And the way you accelerate those, Vinney, is when you buy that retail center, you're not just buying the walls and the land. You're also buying some flooring. You're buying some signage. You're buying a parking lot. And so a cost segregation study comes in and segregates your purchase price into different buckets. And those buckets are short-term assets that allows you to accelerate those deductions.
Beautiful. And the land doesn't depreciate. So if we pay, like, let's say $10 million for the purchase price of an apartment complex, most of my audience is in the, real estate commercial side, right? So if it's 20% land, 8 million is the structure.
Right.
And then how would that depreciate over 27 and a half, or what other years are important,
Yeah. So that 8 million, you're exactly right. Land is not depreciable. So we take out the land value, but then you would take that $8 million of structure and you get to write off 1/27th of that every year for the next 27 and a half years.
Got it. Straight line. That's called your straight depreciation.
Yep. That's a little bit every year, just a straight line. Cost segregation, we would take that $8 million structure and break it up into different categories. Like I mentioned, the 5, 7, and 15-year categories. Your 5 and 7-year categories are your inside stuff. So the flooring, the cabinets, the countertops, the appliances, the ceiling fans, the garbage disposals, all those components on the inside that you bought when you bought that $10 million structure.
Hi, you are listening to Syndication Made Easy podcast. We will be right back after this short break.
Hi, thank you so much. This is Vinney Chopra, and thank you for subscribing to my podcast and YouTube channel and Facebook pages and all the great things, and LinkedIn. Connect with me. I come live to you every Friday at 9:30 Pacific with Vinney and Bo Show. Please also look at that. And also the podcast, which is my Apartment Syndication Made Easy. The book I wrote a couple of years back became international top seller on Amazon International now. And then we like to bring great guests for you every week or twice a week sometime to give you a lot of great knowledge. So please subscribe. You give us 5-star reviews on the iTunes. The better the guests we can bring, and our ranking will go higher also. Thanks again for following us and really getting the most out of it. Please comment, like, share, because we would love to bring better and better material for you.
All those components on the inside that you bought when you bought that $10 million structure, you get to depreciate those over 5 years versus 27 and a half years.
Beautiful.
Now, your 15-year assets, that's all your exterior, your land improvements, things like parking lots, curbs, gutters, asphalt, pavement, fencing, lighting. We're going to put a cost to that and say, okay, of the $8 million you purchased for the building, $1 million of that was for exterior land improvements, and you get to depreciate those over 15 years versus 27 and a half. So you're pushing those deductions up and accelerating your depreciation by segregating those costs into those shorter buckets.
Love it, love it, love it. And then, of course, whatever is balance of the 8 million will be again, taken down by 27.5, and that will be the each year. So it's 5 years, it's 7 years, then it's 15 years, and then it's 27 and a half, in apartments, or 39 years, otherwise. So what's this 5 and 7? What's the difference between the two?
Sure. So the 7-year, there's usually not a lot of 7-year in multifamily. Sometimes we'll find some telecommunication lines or cable lines within the structure, and we'll segregate. Those are 7-year assets. But typically your big categories are your 5 and your 15. That's where we find most of the
Marvelous. So let me also ask a question, which it's been asked in my academy. What if we are taking some value and doing renovations?
Right.
So isn't there some deduction for disposing of certain assets, right?
Yes, that's a great question. So one of the added benefits of cost segregation is something called a partial asset disposition. Mm-hmm. And so especially in multifamily, when you're replacing the carpet every 3 to 5 years, if you don't know the value of that carpet that's in there, let's say you buy the $10 million building, $2 million was land, so you've got $8 million of building. When I go replace the carpet in that building, I don't know what the existing carpet is worth. So what ends up happening is I let's say I spend $300,000 to put in new carpet in all my units. Mm-hmm. That $300,000 gets added to my depreciation schedule as a 5-year asset. And I start depreciating it. But guess what? I'm now depreciating 2 sets of carpet, because I have my original carpet that was in that $8 million basis that's still getting depreciated over 27 and a half years. Mm-hmm. And now I've added a second set of carpet, and now I'm depreciating 2 carpets at the same time, which you shouldn't. Mm-hmm. What you should do is, by doing a cost segregation study on the original purchase, we're going to put a value to that original carpet. And when you come and replace the carpet, you get to take whatever the book value is of this existing carpet and write it off as an expense, which is great because that's an immediate deduction. And so by having your components of your building segregated and broken out, when you replace the roof or you replace the windows or the flooring or the appliances, because you have it broken out, you get to take that old appliance and write off whatever the remaining book value is when you replace it with the new appliance.
I love that. So what you're saying is whatever the value of the old carpet was for whole complex, if you're doing it, the whole 100 units or 200 units, you take it as an expense, as if you just got a write-off. I mean, that's a write-off. Expense is a write-off. Your total income minus depreciation, which is a paper loss. Now you're giving us another component of writing off this old carpet, which a lot of people listening to me, guys, I know you should ask your accountant. You should ask your bookkeeper. Have they done it that way? Because that's a huge, huge thing, which can give you a good bump in the NOI and also the profits, because you're getting that value taken out as expense. And now you're back on a bigger schedule because you're doing a brand new carpet. Right. So, exactly if that old carpet was worth 200,000, you got a loss. Now you're spending 300,000 or 400,000. Now you're depreciating that over 5 years.
Right. No, that's exactly right. So if you look at your depreciation schedule, or any of your listeners look at their depreciation schedule and they see building 8 million, and then underneath that they see flooring for 300,000, chances are they're depreciating 2 sets of flooring, because that first flooring is stuck in that $8 million category, like you said. Yeah. So it's definitely important to break those up so you can take advantage of those partial asset disposition.
And it could be like for not only just the flooring, we just took an example of that, appliances, because some of these appliances, the seller might have put it 4 years back or 5 years, but now with new, granite and everything, I mean, you want to replace those, well-working appliances, or sell them. Why not? Denting place or other places, they come and they pick up the whole thing and they'll, clean it up and sell it again, as a package. So we can take those out also. Right. Wow. This is amazing. And then you get a new basis of the brand new appliances on a 5-year schedule. Right. Just right there.
That's it.
I love it. So let me kind of ask you some questions about, what is the minimum size of the asset one should do cost segregation. I've been asked that, and I have a triplex or a fourplex or 8 units. Is it worth doing it? The cost is too high, or is it going to make a dent in the profits, right?
No, absolutely. So, that's a great question, because cost segregation has been around for a number of years. And in the past, I would have told you $1 million, $750,000 asset would make it worth it.
Yeah.
There was a change to the tax law in 2017 with the Tax Cuts and Jobs Act, where Trump came in and made some changes with something called bonus depreciation.
Yeah.
And so bonus depreciation has really made cost segregation more feasible for some of the smaller projects. So at our firm, we do everything from single family rental homes up to large apartment complexes or ski resorts. You could have a $200,000 duplex, do a cost segregation study, apply bonus depreciation, and now all of a sudden you've got, a $30,000 write-off. And if you're in a 30% tax bracket, that's a $10,000 tax savings.
Sure.
And the study might cost you $2,200.
Wow.
So you're still coming out ahead.
Yes.
But, usually on the smaller projects, you don't see as big a ROI, but it's still oftentimes very well worth it, especially with this bonus depreciation.
I love it. Explain that more. I know it started and now it's waving it off, right? Or something. So give us a good spectrum when it got started, how it was, and now it's 80% or 70 or 60. Give our audience some good flavor of that, brother.
Oh, sure. So bonus depreciation started any assets that were purchased after September 27th of 2017 through the end of 2022. So over that 5-year window, you could take 100% of your depreciation in the first year on your 5, 7, or 15-year assets. So remember, your 5-year assets typically get depreciated over 5 years, your 7 over 7 and your 15 over 15.
Yes.
So with bonus depreciation, it allows you to take 100% of those write-offs in the first year. And so it's really taken cost segregation and put it on steroids. And like I said, made it available to a lot smaller investor because it still makes mathematical sense. Now, bonus depreciation is phasing out, like you mentioned. So the current tax law, anything from the end of 17 through 2022 is eligible for 100%. Starting in 2023, it drops to 80%.
Yes.
And then 2024, 60%, 2025, 40%. And then in 2027, it's completely gone. So the important thing with that is it's not when you do the cost seg study, it's when you put your asset into service. So you could buy an asset this year. Let's say I buy an asset tomorrow and I don't need the deduction. So I'm going to hold off and do the cost seg in 2025. I still get 100% bonus because I bought that asset during a period of 100% bonus.
Oh, really? Oh, wow. Oh, so, this is amazing. So we should really buy lots of assets this year, right? And then even do it this year, right? If you want to do the taxation, and 2023, you could take 100% deduction, of the bonus for this, or wait, like you said, even 25, because you bought it before the end of 2022, it will apply.
That's correct. And that's the nice thing, Vinney, about cost segregation. There's a lot of expenses that we incur as real estate investors. We have to use that year. If I go buy a bunch of new toilets and I expense them, I have to take that expense this year. Right. Cost segregation is very flexible, where if you don't need the deductions this year, you can just keep that cost segregation study in your back pocket. And you can use it as you need it. When you have a high income year, you can use the cost seg study. So you don't have to cost seg it right when you buy it. Now, it's a little bit different when you're talking about syndications. And, typically on syndications, you're going to cost seg the property right when you purchase it so that you can pass that depreciation down to your investors.
The limited partners love that passive loss. We give them those dividends, the quarterly distributions.
Right.
They look at their K1, Vinney, hold on. Is this asset doing good or not? It's showing me it's going in loss.
Right. No, that's what you want. You want that big paper loss to reduce your taxable income so you don't have to pay tax on it. So that's one of the great advantages of these multifamily syndications is oftentimes an investor can come in with $100,000 contribution, and they might get an $80,000 deduction that same year. So they're getting almost dollar for dollar back in terms of what they're putting into the deal. So it's a great opportunity to raise money and help out the investor.
I love it. I love it. Now, is it also true that, like, let's say you